In today's video, I am going to talk about the importance of seeing different options and different ways to look at whole life insurance policies. This all falls under the umbrella of setting up a whole life insurance policy for maximum cash value. We're going to look at a specific case study of a 50-year-old individual. He's actually a doctor interested in a whole life insurance policy, and he's been doing his research and he has an idea as to what he is looking at from his research thus far. However, from the limited engagement we've had thus far, just from what he had provided, it resembled what we see a lot, meaning someone's interested in option A, but if they see different options, they might be interested in perhaps options B, C, or D. Meaning what we want to prevent is just saying, hey, you asked for option A, here's option A. I'm not even going to show you what could be a better option that a lot of people have expressed interest in. I hope that made sense. Let's go through some details. We'll have some fun with this one. So to kick things off, what we have is a 50-year-old physician interested in a whole life insurance policy, and high cash value is his goal. This is one of the first things he emailed. He said, I want a whole life insurance policy. High cash value is what I'm interested in. The funding, about $25,000 per year. He had mentioned $2,000 per month. And he said maybe for 20 years. So for 20 years, if he's 50 years old now, that's funding the policy up until 70 years old. He can do that. He could go longer. He could also go shorter, but that's what he's interested in right now. And if we look at that funding amount, so if we take the $25K per year for 20 years, how much total funding goes into the policy? $500,000 with the objective of maximizing cash value. He can use it for retirement, and the life insurance protection is also an added benefit. So we could stop there and say, sure thing, here you go. Here's the $25K per year for 20 years. You've got some flexibility, but here's what it looks like, and stop there. If that's me, however, knowing what I know about life insurance, would I only want to be shown that option? I did ask for it. However, if I'm working with a friend that says, I know how you think, Steve, here's the option you asked for, but let me ask you a couple questions. Would you be interested in a policy where perhaps you fund it for a shorter period of time, maybe with a larger amount of money, or a different product that can potentially generate stronger cash value performance? Would you like to see that, or do you just want to proceed with this option? Personally, I would say, yeah, I wouldn't mind seeing another option or two just to compare things side by side. So we're going to do exactly that. It reminds me of a story when I was in high school. I had walked into a running store. I was on the track and field team. I was running the 800 meter. That was my event. I liked it a lot. And I remember the prior year, there was someone who just really kicked my butt. Right? He killed me in the race. He ran fast. I didn't run fast, but I remembered his shoes, his track spikes. I'm like, okay, this guy's going really fast. He had some high-end track shoes. That's what I wanted to buy. So I go into the store. I see the pair that looks just like that. I say, that's the pair I want. I try it on, feels good. Okay, looks good. I check out. And as the owner of the store is ringing me out, I'm looking over at the track shoes, and I see a different pair that looks more like what this other individual had. In fact, the pair I was looking at were the high-end version. They were lighter, and I thought in my mind, if I go with those ones, I might be able to run faster because that's the high-end one. And again, I think that's what the competitor actually had. The owner did not just ring me up and sell the pair that I had purchased. He said, I noticed you're looking at those other shoes. That was a good line he used. Like, yeah, what's the difference between those? To make a long story short, I ended up purchasing the high-end, lighter track shoes, and I'd like to give credit to those shoes for the times I was able to run. No, I'm just kidding. The shoes are important, but the training is really what's important when you are in the game of track and field. But my point is, I walked into the store knowing what I wanted. Let's say those shoes cost $25,000. Yeah, I would not spend 25 grand in shoes. But let's say they cost that. But then I see a high-end version that allows me to run even faster, but they cost a bit more. Would I be interested in that? In that particular case, yes. So how can we relate my weird racing shoe story to this doctor's life insurance purchase? Well, here's what we can do. He's interested in the $25K per year for 20 years. If he goes with that, I would gravitate toward that product. a MassMutual high yearly cash value. If I'm just going to show one option, that product will display strong guaranteed and non-guaranteed values on a long-term basis. It's an option where I can go with a minimum premium and continue to pump money into the product for a long period of time. Very quickly, here's what it looks like. A high yearly cash value product, strong option when we look at the policy performance, or I should say a breakdown of the policy design. We've got the annual net outlay, $25,000 per year. Here's his net cash value, just about $23,000 in the first year. Base premium, very close to 10%. $2,700 and change. Got a term insurance rider attached, PUA riders attached, beefing up the cash value, breaking even just about year 5, and year 6 he's positive. And if we scroll down, he's funded this particular illustration, or he's funding this policy for 20 years. So we could just stop there. Is that a good idea? For some, perhaps, depends how quickly he wants to move, which is why, in my opinion, it's beneficial to ask the question, would you be interested in seeing additional options? They say, no, this is what I want. That'd be the option. And perhaps I show one other option. Maybe it's a whole life 100 that has stronger guarantees, but weaker non-guarantees. So we can see that as far as the difference in guaranteed and non-guaranteed values. But if the answer is yes, I would like to see some alternate options, what do your other clients do? Or what do individuals in similar positions to me typically do with whole life insurance policies? Here's what I would do. Well, the first thing I would look at is option B. While the high yearly cash value product is a good option, I picked that option initially because of the 20-year funding. So you had stated maybe 20 years. So the 20-year funding, you say maybe, would that be the longest you ever want to fund the policy? The answer is yes. Then I would ask a follow-up question. What about 15 years? That might be more realistic. Maybe it is 20 years. I don't know. Well, the reason I bring option B up, the same $25K per year for 15 years, MassMutual has another product here, their 15-pay policy, which when we compare it with the high yearly cash value product, you'll see lower PUA fees, and a little bit stronger internal rate of return, meaning the cash value performance will be a bit more attractive with all things equal comparing those two products. Let's take a quick look here. So we can look at this guy, which is the 15-pay policy. So similar premium here, we minimized it. Death benefits less initially, but you've got the $25,000 per year going in. Then we've got the total cash value at $21,000 and change instead of the other one was approximately $23,000 and change. Break even right at year 5. Why don't we do this? This will be a little bit easier. Let's compare these two side by side. We'll have some fun with this. Here we go. So on the left, we've got the high yearly cash value product. This is the first option we looked at that allows him to continue to make payments for 20 years. He can continue to make payments up until age 85 with this product. That's how long the premiums do. So if he likes the idea of being able to constantly fund the policy up to $25K per year, that high yearly cash value product will accommodate that. It's a really, really big advantage to MassMutual. If you design a product right with their lister and ailer riders, you can do a lot of damage in a good way, meaning maximize the policy performance. But when we compare the two, what do we notice here? So let's first look at the high yearly cash value product. Annual IRR, the net growth rate, the dividend rate with MassMutual for 2023 is 6% flat. The dividend rate is never what your policy is growing by net. That's always a gross rate that's applied to your policy after the insurance expenses and everything that comes with the life insurance product. So my point to this is here's what I want to look at. What's the net growth rate over time? This is the annual IRR. Tops out down here a little over 4%. Yearly cash, so that column's too small there. Let me expand that a little bit. There we go, yearly cash value growth. If I prefer dollars instead of annual IRR, instead of percentages, that's where that column is great. So what we can do here, take the same thing, Just paste it over here. And what do you notice? Well, the first year, a little bit weaker with the 15 pay product. However, as time passes, what happens here? Well, I see the 15 pay product breaks even a little bit earlier. I get less money into the product. So this would be a choice here if he is comfortable with getting less money in, $375 instead of $500, because I'm stopping after 15 years prior to age 65, getting less money in. Look at the IRR. Difference there, isn't there? If this is you, which one would you want? Even if you pick this one, would you want to be made aware of this guy here? I've seen this go both ways, where people have considered both options. Some say, hey, thanks so much for showing me this. That is a noticeable difference. I'm going to go with this option. And then some have said, I remember one distinctly where it said, wow, that's a big difference. I'm still going to go with this option because I want the ability to continue to add to the policy. So it is a personal choice, but being able to see it up front helps us or helps prevent a feeling of, oh man, I didn't see that before I started the policy. I wish I did. No one wants that. All right, let's keep going. So interesting there, isn't it? When we look at everything side by side, the high early cash value will have more money because I've pumped in another $125,000. So there's options A and B side by side. Another thing to hit on here, this will be interesting. We've got options C and D. So if we eliminate option B, let's assume this is his goal, $500K total. And initially he thought, hey, over 20 years, $25K per year, that's something I'm very comfortable with and it's not going to hurt me at all. Like I know I can do that even once I retire. So we'll run into cases like this where someone has a target dollar amount they want to get into a policy, 25K over 20 years, that's $500,000. But what if we accelerated the funding? 50K per year for 10 years. Well, in that case, I would go with the Mass Mutual 15 pay. What if you condense it even more so? Say it's 100K per year for 5 years. Very aggressive. Then I would actually go with the Mass Mutual 10 pay product. And why I would pivot here is because the minimum premium dollar amounts, based on his age and such, a 10 pay at 50K per year forces a higher base premium than I would normally be comfortable with or what I would normally do for myself. I can get it lower with that 15 pay. We're at 100K per year threshold. Now I can go with a 10 pay product, which when you compare this with all Mass Mutual products and all things are equal from a design standpoint, you'll see some nice internal rates of return. They position these two products really as cash accumulation products in their portfolio. So let's look at this. Let's look at A, C, and D side by side. So if this is you, what are you doing here? You're getting a total of $500,000 into the policy. You're looking at the same exact insurance company, but you're doing it over different time periods. There's our 15 pay for 15 years. Let's get rid of that. Here's 50K per year for 10 years. And then here's 100K per year for 5 years with the 10 pay product. So let's take a look here. This will be fun. Next tab. All right, so here we go. We won't look at the IRRs and such on this column. There we go. What we're interested in is really which one gives us more money. Let's just simplify this. Because what's consistent about these options? Total payments. High early cash value product, because it allows for funding up until age 85. This is a great option for a 20-year funding plan, particularly where I want to keep my base premium very low, so I've got more flexibility and higher cash value. Then the 15 pay product. 15 pay means you can pay into it for 15 years. It does not mean that you have to pay into it for 15 years. So what we've got going on here, if we go back to the illustration, you'll see this, 50K per year for 10 years, 500K total. If we look at the same year 20 mark, what do you notice here? There's a difference. And this makes complete sense. I mean, what's going on here? You're getting money in faster, larger dollar amounts too, which is going to go to work for you faster. It's going to compound. Like that's what's going on here. Plus you have a product with lower PUA fees that's designed to have a higher internal rate of return than the higher the cash value. Like that's why it looks stronger. But then over here, what if we condense it even quicker, which I would then pivot to the 10-pay product. Look at that, breaking even between years 3 and 4. If we look at the same year 20 mark, well, now you've cracked $1 million. And these are all non-guaranteed values. Things will change over time. But what's interesting about this is we've got the same company, different products, but all other assumptions are the same. Same health rating, same age, same policy design with respect to minimum premiums, maximum cash value. Like we're trying to juice everything here. So this is a nice option to see side by side, all going back to what he was originally interested in, which was what? The 25K per year funding, maybe for 20 years. Would you like to see some alternatives? One last thing, I'll wrap up here because this is a point a lot of people have liked, is if you're leaning toward option D, you say, you know what, I like the idea of getting money in quickly, and I think I can do that based on my situation. But 100K every year, I don't know that I'm going to be able to do that in February or whatever my policy anniversary date is each year. Can the policy be set up to be very flexible? And this is where we start to get into different company and product selection and flexibility rules, which I can rant on all day long about. And I'm not going to do that today, I promise. So what we can look at here is option D, but with flexibility. So what I mean when I say that, sticking with a quality company, one of the 4 major mutuals, we can look at Guardian. Let's take option D, D as in dog, 100K per year for 5 years. And what Guardian will allow us to do is to have a design where we are committed to $10,000 per year total, like that's literally what we're billed for, and then we can add more funds to our PUA rider at leisure. So if we look at that, how that works is like this. It's pretty cool. So here we go. Perfect. What he's committed to is what you see toward the top right. Here's his base premium. Age 50 male, regular preferred. Here's his term rider. So when asking what am I actually billed for each year, it's the base premium plus the cost of the term. Paid up additions rider here reads scheduled. Most people will set this up on an unscheduled or to be unscheduled, meaning you add it whenever you'd like. I ran it as scheduled because it's quicker when putting these illustrations together. That's the main reason why. But you'll see everything function in an identical manner, assuming unscheduled PUA payments are made at the beginning of each year. If you're adding unscheduled PUAs over the course of the year, the cash values will be a little bit less than what the illustrations display because the company will begin to apply any dividends and guaranteed interest based on the month that you actually make that PUA deposit. So as we look at this guy, here's our net cash value down here, breaking even between 3 and 4, which is fantastic. But the purpose of this illustration was to display what? That minimum commitment. Now we can commit to a small amount and have the flexibility to add more funds at his discretion. So let's take a look at this side by side. And here's what we've got. Again, just more options, right? If you're at the store, not to overwhelm someone. That's not the purpose of this, but it does help show some flexible options, right? Here's the 25K. Here's 50K just for 5 years. Here's 100K per year for 5 years, and we can design them differently. But typically what we found when someone is very interested in a whole life insurance policy, they want maximum cash value, They start out with a certain dollar amount, but then they think about expanding that, which is very common. Typically, when someone starts a whole life insurance policy, what I've always seen to be the case, individuals want to continue to add more as time passes, or at least up their payments a bit if possible. The main reason why is because no one likes the first year because they take that hit, but as time passes, I get more and more of my money back as the policy starts doing its thing. So if I can add more money to the product, that's fantastic. So point to that. It's very common to see someone start out with a policy to say, okay, let me commit to a minimal amount, or let me say I'm interested in $2,000 a month or $25K per year. Then when they start to understand it, they say, okay, I would like to go a little bit more aggressive here because I see how it works over time. And the added death benefit too, this comes into play so often long-term when we look at that with other assets that one has in play from an estate planning standpoint. There's a lot of value there because remember that death benefit is paid income tax-free, and there's other benefits that comes with it as well, especially when we look at the estate planning side of things, which I'm not an attorney, but we will involve one or recommend involving one. Anyway, I hope you enjoyed this video. Let us know if you have any questions at all, or if you would like to see any options. We always love talking about this stuff. I do hope that this video was helpful, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.